San Francisco State University Finance 372, Team 5, Take 5, and Action.
Good evening, class. We'll be presenting Essex. My name is Simon.
I'm H.U.
I'm Trevor.
And through our calculations, we had a intrinsic value of $200.53 of the premium of 5% compared to the current value of $247, which is a buy. So for the agenda today, we'll be going over the background, the company overview, the current financial conditions and stock valuations, and some recommendations at the end. Currently, the Essex is traded on the New York Stock Exchange under the ticker symbol ESS, and the current CEO is Michael J. Shaw. And it was founded by George M. Marcus, founded in 1971. Current headquarters in San Mateo, and they're currently, most of their properties are Northern, Southern California, and Seattle. Here's a list of their leaderships. There's Michael Shaw, the CEO. And this is the SWOT analysis. Some of their strengths are that they experience property management units, favorable demographics. Some of their weaknesses, that there's a competitive market and they're mainly focused only on the West Coast. Their opportunities, that they could probably expand throughout the U.S. Some threats are increased price in raw materials, rising labor costs. And we're going over the products and services. Some of the product services are that that they acquire and develop and redevelop, manage multifamily apartment communities located in the West Coast, mostly in California and Seattle. They have a 23-year history of increased dividends. The company's strategy pretty much is Essex has upheld its disciplined, research-driven approach to investing and supplying West Coast markets, and has maintained a solid balance sheet with a strong management team, well-defined strategy. Essex is poised to create value for residents and their shareholders.
Now I'd like to talk about the industry overview. We decided to compare the Essex with their top 4 competitors in the market. As you can see here, using market cap in millions, you can see that Essex is third in the group with a 18% market share. Next, I'd like to go over the financial conditions. We decided to compare equity ratios and growth rates in the last 3 years. We use price per earnings. We also use dividend yields. We also use revenue, growth rate, operating income, and earnings per share net growth. We decided to compare Essex to the industry overview. Price per earning is 31 times versus the industry's 18%. We give an excellent condition. Dividend yield, we have a 2.8% versus the industry average of 3.9, so we gave it an average. Revenue is 28.3 compared to the industry average of 10.4, which we gave an excellent condition. Operating income is 30.6 compared to the industry average of 19, so we get an excellent condition. Earnings per share net growth, we have a 15.8 compared to the industry average of 20, so it's a little bit below average. Overall, their condition is excellent. And now I'd like to do the financial conditions for Essex for profitability percentage and leverage ratio. We decided to use net profit margin, ROA, ROE, debt to equity ratio, and interest coverage ratio. So for Essex, the net profit margin is good. ROA, their condition is good. ROE with a 6.6 compared to the industry average of a 12, we give it an average condition. The debt to equity ratio, we give it a good rating, and an interest coverage ratio, we gave it the low average rating with an overall good rating. Next, I'd like to go over the technical analysis. I want to give the resistance line, the support line, and the trend line. For the support line, the very bottom right here, we believe it's around $216 around. When we say that, because none of the prices have dropped below $2.16, it's $216 ever since they entered the 2017. We want to say the new resistance line is around $250 around, since they haven't hit that price yet. Some people can argue a different resistance rate just because the price is going up within the last month, so we still don't know where it's going to stop and go down. The trend line, we decided to go from the very, very bottom, which was February 2016, all the way to the current price. And using this technical analysis, we predict that the target price will be $250, which is a premium of 1% compared to the current price at $247. Next, I'd like to talk about the valuation, the perpetuity model. For CAPM, we solved for CAPM by using a risk-free rate, which we got from Fidelity, which was 2.5%. we got the asset beta, which is 0.6. We got that off value line. And the S&P 500 gave us a 8 to 10% expected market return. We decided to go with the 8% because we want to be conservative, which gave us our CAPM, which is 6%. The FFO per share, we got that off REITwatch as well as the growth. And we decided to go with the 5% growth rate going on in the future. We decided to go with the 6% because 6% was our CAPM, and we just thought that was the safest route since it is CAPM. And that gave us a $205 valuation, which is a lot less than the $247.60 current price with a discount rate of 17%. Next, I would like to talk about the valuation for the Gordon growth model. We use the same thing for the CAPM. We use the same FFO from REITwatch. The only thing that's different is the number that we divide by. We use 6% from the CAPM, and we decided to go with a 2% growth rate model. So you do rate minus growth, and then divide that number over the FFO per share. And we got the intrinsic value of $307.50, which is a greater value than the current price, which is $247.60, with a premium of 24%. I'd like to pass it on to Trevor.
So next is we're going to go over the multiples approach valuation. So for a peer group FFO multiples, for Essex we chose 19 times for 2016, 21 times for 2017, and we made a guesstimate of 20 times for 2018. So that's why we chose for the FFO multiple, we chose 20 times with a REIT value of $246, which gives us a discount rate of 1% from the current stock price. Next is our discounted cash flow valuation. So we got a weighted debt of 47% and a weighted equity of 53% from Google Finance, and we chose a return on debt of 4.5% because we want to be conservative, and for our return on equity, which is our CAPM, so we got that so that became a 6%. Through calculations, we got a weighted average cost of capital of 5%. For FFOs, we did a 5-year take on it with a terminal value of $318, which gives us a intrinsic value of $259.40. So then we chose the WACC of 6% because of CAPM, which gives us a REIT value of $259.40, which gives us a premium of 5% from the current stock price. Next is our net asset valuation. So our net operating income, we got $512 million with the shares outstanding of $65.6 million, which gives us a net operating with an NOI per share of $7.80. So we chose a cap rate of 3% with an NAV of $260, which gives us a franchise value of $12.40 and a premium of 5% from the current stock price. Next is our weighted stock evaluation. So we chose the second weight, which has a 5% for perpetuity, 10% for Gordon growth, 45% for multiples, 35% for DCF, and 5% for NAV, which gives us an intrinsic value of $253.40. So that's why we recommend an intrinsic value of $253.40 with a premium of 2% with a recommendation of a buy. So then we have total trades of 12. For stock and ETF, we have buy on margin, buy calls, write puts. And for indices, we have buy forwards, buy futures, buy calls on futures, and write puts on futures. And these are our references.